Okay, so welcome to the session. My name is Valerie Ramey. I'm a senior fellow here at the Hoover Institution. And this session is on employment dynamics, labor markets, Phillips curve, and inflation. And of course, in any monetary conference, understanding the condition of the labor market takes center stage, not only for the dual mandate, but also because of the Phillips curve relationship between the state of the labor market and inflation, even though the stability of such a relationship has become a will-o'-the-wisp of our profession. So our three speakers today are Steve Davis, who's also a senior fellow at the Hoover Institution, Marianna Kudlyiak, who is a research economist at the Federal Reserve Bank of San Francisco, and Emi Nakamura, who is a chancellor's professor at the University of California, Berkeley. And our first speaker will be Steve Davis.
Thanks, Valerie. It's been a great conference so far. So thanks to John, and Mike for organizing it. We did not plan it. I did not coordinate it, but my remarks are actually going to be quite complementary to what you heard from Yuri Grodnichenko earlier today. So I want to remind you of three related observations he made about the recent disinflation. It's been surprisingly rapid. It looks nothing like a Phillips curve relationship. And it's hard to attribute all or maybe even most of it to monetary policy tightening. Instead, I'm going to argue that much of it is best attributed to some really extraordinary developments in the labor market. They're somewhat recognized, but their implications for, I think, wage cost pressures are much less recognized. So that's what I'm going to focus on. And I will also argue that these developments came at a fortuitous time for the Fed in its effort to disinflate, but that there's not really much, that these forces I will talk about have largely played out, and so we shouldn't count on that going forward. So here are the extraordinary labor market developments I'm going to talk about fall into two broad buckets. First, social distancing effects. There was a big labor force withdrawal and then a return. And as that return unfolded, that increased labor supply and probably had effects on reducing wage cost growth pressures during that return. What I think is probably an even bigger factor is the big shift to work from home. I will simply assert it here without providing you evidence, but I've written on this at length elsewhere, that the productivity consequences of that big shift were surprisingly benign, even positive in some jobs and tasks. Nonetheless, it was a big positive amenity value gain to the people who were able to work from home part of the time. So there was basically an amenity value shock, okay? There were also new locational flexibility, and new working arrangements, obviously part of the same thing. So I'm going to show you some evidence on these. I'll go pretty quickly. The first issue, the first on the social distancing side, though, this draws from a paper with Jose Maria Barrero and Nick Bloom that was published late last year. What you see on this chart are four different time series curves, each of which reflects a different method of estimating the extent to which social distancing and infection worries were operating as a drag on labor force participation, and hence pulling down aggregate labor supply. So the solid blue line is based on a regression model that relates stated social distancing intentions, or I should say relates labor force status to stated social distancing intentions. According to that measure, the peak negative effect on labor force participation was about 3 percentage points, and since early 2022, that has been rapidly dissipating. The identification assumptions that are at issue there are kind of the standard ones we're familiar with from econometric investigation. So the assumption here is that the stated labor force intentions are exogenous, conditional on the other controls and the regressions. The other three lines are drawn from an entirely different method. Three variants on the following. You ask people who are not currently in the labor force, why aren't you? And you tabulate their individual responses and then you aggregate them up. There are 2 independent surveys that I've drawn on here and 3 different sets of question designs. You can see that these different methods and different surveys deliver somewhat different answers about the levels, but they all share in common that since early 2022 or so, there's been a return to the labor force. That is a reversal of the withdrawal that occurred. That's obviously going to, other things equal, bring down wage cost pressures during this period. Now you can take 2 of these methods, the regression method and the self-assessment of why you're not in the labor force method. And remember, these are completely different methods. They rely on completely different identification assumptions. By the way, I forgot to state the identification assumption in the self-assessment method is that you've elicited, that you're resting on the assumption that you've elicited accurate explanations for one's own behavior. So this is showing you across various groups that these 2 completely different methods tell pretty similar stories in the cross-section, and there's some interesting aspects of this cross-sectional variation. So the withdrawal from the labor force due to social distancing and infection worries and the return is very much concentrated at the lower parts of the earnings distribution, among the very oldest people and among the least educated people. And among people who kind of fit the profile in this room, highly educated professional class, there was really not much going on. You can see that in the bottom left. Now, our paper doesn't actually try to estimate the impact of this on the overall wage level. Instead, what it does is feed these labor supply shifts into a competitive equilibrium model with a stable production technology, parameterized with kind of standard elasticity, substitution elasticity measures between the 2 education groups and across age experience groups within those education groups. And this is what pops out of that exercise. The point of this picture is these, at its peak, this is kind of as of 2022, the impact on the relative structure of wages across age and education groups were non-trivial. So this is some indication that these things actually amounted to, something that would matter in the context of trying to bring the inflation rate down by a few percentage points. So you can see that the story I fleshed out earlier, this reversal process played out in a period of time when the Fed was becoming, recognizing that it needed to take serious efforts to disinflate. And my claim here is that this worked to help the Fed bring inflation down without generating much unemployment. I think this process is essentially played out. This particular mechanism is essentially played out. The return has happened. Now, what about the big abrupt and lasting shift to work from home? I've kind of laid out part of the argument already. Here's the evidence, at least my preferred piece of evidence on what's happened. Before the pandemic, maybe 7% of full paid workdays were done remotely. In the last two years or so, we've settled at something like 4 times that level, okay? Part of the reason that we didn't revert to the pre-pandemic situation is this, as I suggested earlier, we learned that in some jobs, some tasks, some organizations, this actually works pretty well in a productivity sense, and people really like it. So how does that tie? Into the wage cost pressures? Well, here's just a list of the direct benefits of work from home that accrues to the people who get to work from home. The first one is probably the most important. It's certainly the most obvious, and that is it saves on the time and money costs of commuting. For people who are on this margin in the United States, that's about 65 minutes of time savings per day worked from home instead of on the employer's site. There's some other benefits that I think get less attention. They're not, I view them as important for some people. Adds flexibility in time use over the day, increases personal autonomy, relaxes locational constraints. I'll come back to that one. And for some people, work from home is also a complement to caregiving activities that they want to take a part in at home or near home, like caring for an ailing parent. Now, if you ask people directly, you find out that most people value the option to work from home part of the week. Most people don't want to work from home all the time, but they like the idea of working from home a couple days a week for the reasons I just mentioned. And there's a sizable number of people who claim to value it very highly. The mean value, mean stated preference for working from home in this data, a rough cross-section of the U.S. workforce, is about 8% of pay. That's pretty big. Some much more narrowly focused studies find, using kind of experimental methods, find similar values. So I'm going to take that as a rough indicator that this matters a lot to many people. Now, what happened in the wake of the pandemic? We had the big shift to work from home, and if you buy my arguments that I've made so far, that raised the amenity value of employment in many jobs. But of course, initially that happened at wages that were set before the shock arrived. The pandemic and its effects on our economy were largely unforeseen. Economic reasoning from any model I can think of, from a competitive model, a bargaining model, anything in between, suggests that over time, these amenity value benefits will be shared between the employer and the employee. Exactly how they will be shared depends on the model at hand, or the details of the model. So initially, all the benefits accrue to the workers because wages were predetermined. Over time, they're going to get shared with the employer. How will that sharing take place? It'll take place in the form of wage growth moderation along the transition path to an equilibrium that recognizes the new working arrangements. So I'll show you three pieces of evidence that kind of are supportive of this view. The first is the most direct. Back in the spring of 2022, I worked with the Atlanta Fed to field a monthly survey of business executives. In the spring of 2022, we asked them questions directly about their own firm. Looking back over the past 12 months, have you used expanded work from home as a way to keep your employees happy and to moderate wage growth pressures? About 40% of them said yes. If they said yes, we asked a follow-up question that elicits a quantitative number about how much they think wage growth, the expanded work from home, moderated wage growth pressures at their firm over the past 12 months. And many of them just said zero. Okay, so we're allowing for that possibility. We asked a parallel set of questions in the forward-looking direction. I'm not going to show you those here, but then we integrated over all the firms in our sample, including the majority who said it didn't do anything for us. And the aggregate wage growth moderation that comes out of that exercise is about 2 percentage points over a 24-month period centered on the spring of 2022. So that's a non-trivial reduction in the wage cost pressures during a critical time in which the Fed is trying to disinflate. Now, different kind of evidence. Real wage growth has been remarkably sluggish in the past 3-4 years and still hasn't really recovered. And often that's when I talk to people, that's typically attributed to the surprise inflation. So your real wages are sticky, so it takes a time to adjust. But they haven't caught up. So let me show you that. I wanted to just mention some facts first. So if you look in the period before the pandemic, if you look at the employment cost, the employer cost index deflated by the CPI, you get about a 0.4 percentage points per year gain in real wages from 2006, it should say, to 2019, not 2009. And in the wage tracker, about 1.1 points per year. The reason I emphasize these two real wage measures is because they both make some efforts to control for composition bias, and there's been enormous changes in the composition of the workforce and jobs over this period. So that leads you to think that in the period from about early 2021 to early 2024, we would get at least a real wage gain of 1.3 percentage points by the ECI measure and 3.3 by the deflated wage tracker measure. We got nothing like that. Instead, we got this. You can see what's happened to real wages. The Atlanta Fed real wage tracker measures is kind of back to where it was in 3 years ago. The ECI is still below. So if you're still somewhat skeptical that this is the right interpretation, here's a breakdown of the ECI by industry sector. It doesn't perfectly line up with the story I'm telling, but I don't think it's coincidental that the sectors that have had the strongest real wage growth by the ECI measure in the last 3 years are leisure and hospitality and retail trade. Those are sectors in which there's not much scope for work from home. And then at the bottom there, with a whopping nearly 8 or 9 percentage point decline in the deflated ECI, is finance and insurance. So let me summarize that evidence, put it together relative to what we would have expected from the pre-pandemic trend. Real wages are down at least 3.5 to 4.4 percentage points in the last 3 years. I say at least because in the interest of time, I've ignored the fact that by all standard labor market indicators, we had extremely tight labor markets in the past 2 years or so. So you would have expected, even more rapid wage growth. All right, so here you can see this came at a fortuitous time in the Fed's efforts to disinflate. Okay, I'm running close to the end. I will just, which is good. I think I'll be able to finish in a minute here. So I think the forces I've talked about on the work from home side in terms of their moderating effect on wage cost pressures have also largely played out, but there is some ongoing consequences of the shift from work from home that will continue going on into the future. One is that workers are becoming less tied to their employer locations, and among other things, this is just an illustration of that from one data set. This data set may overstate the extent of the phenomenon. I don't want to claim this is a representative data set, but what it shows you is that people who've been hired since the pandemic are living much farther away from their employers than people who were hired before the pandemic, which gives people an opportunity to live in lower cost locations and gives employers an opportunity to recruit more heavily from lower cost locations, obviously bringing down the wage. And then I'll end on this slide. The big shift also brings many new options to introduce flexible working arrangements and expand job options in ways that have the potential to expand the labor supply. And I know I'm running out of time, so I won't. Okay, thank you, Valerie. So basically, there are many groups out there for whom it is a struggle or to either find a suitable job or to commute to the suitable job 5 days a week. And so persons with physical impairments that inhibit commuting or that require special accommodations, it's a pretty large slice of the US workforce. And if you look at the data on what's happened to labor force participation rates by disability status in the US, just in the cross-section, and this is a very crude examination of the data, but what you see is the labor force participation recovery is especially pronounced among people in the CPS who say they have disabilities. So there are other people, people who face dual career constraints, people who might have psychological conditions that make it hard to deal with face-to-face encounters, and just people who live in remote areas where there's a scarcity of jobs that would allow them to fully utilize their labor skills. These are all potential ways in which going forward, and this would unfold over years, there's the hope at least to bring more people into the workforce. And while I wouldn't count on that from the monetary policy perspective, it's another, I think, positive development of the shift to work from home. Thanks.
Okay, good afternoon. It's a great pleasure to be here. Thank you to the organizers for inviting me. I'm going to present joint work with Bob Hall, and I will talk about unemployment and inflation in the monetary policy armamentarium. And the usual disclaimer applies. The views expressed here are those of the authors and not the views of the Federal Reserve Bank of San Francisco or the Federal Reserve System. So let me start with the following figure. So the blue line here is unemployment rate. The brown line is inflation. So in the last 15 years, since 2009, we can say that the unemployment rate and inflation exhibited behavior that is hard to reconcile with a conventional view. Specifically, during the recovery from 2009 to 2019, the unemployment rate went down from 10% to 3.5%. At the same time, inflation remained close to its 2% target. Then, in the pandemic cycle, unemployment shot up to 14.7%, while inflation didn't move much. Then unemployment quickly went down, inflation rose and went quickly, and now remains a little above the target. So I'm going to present the findings from our research on the unemployment recoveries and the natural rate of unemployment to try to help explain this behavior. And specifically, I'm going to talk about three things. First, I'm going to talk about the inexorable recoveries of US unemployment. Second, I will talk about the natural rate of unemployment during 2009-2019 recovery. And third, I will talk about unemployment and inflation in the pandemic cycle. And specifically, I will talk about two kinds of unemployment: the temporary layoff unemployment and unemployment due to other reason. So the entire increase in unemployment during the pandemic came from temporary layoff unemployment. But that kind of unemployment is not associated with declining inflation. The other type of unemployment increased only slightly. All right, so let me go to point one. So inexorable recoveries of unemployment. So in this figure, I plotted log unemployment during cyclical recoveries. So recession periods are left blank, and here we plotted only recoveries. So basically from the period when unemployment is highest during recession and all the way until it starts going up again. And so we make 2 points about this figure. First, the speed of the recovery remains approximately constant during the recovery, and we measure that speed. And second, that speed remained approximately constant across pre-pandemic recoveries. So when analyzing the historic behavior of unemployment, we see that the behavior of unemployment comprises occasional upward movement during the economic crisis, and then the downward glide along a predictable path at a speed of approximately 10% per year. So basically, if at the beginning of the year unemployment is 9%, it declines at approximately 0.9 percentage point in a year. And this glide continues until another economic crisis intercepts the glide, or historically until unemployment reaches approximately 3.5%. And so we asked, what can be behind these inexorable recoveries of unemployment? Because there was substantial variation in monetary and fiscal policy, substantial variation in productivity growth and labor force growth, but it looks like there was not much variation in the speed of recovery of unemployment. And our thesis is that the economy has a powerful self-recovery tendency, and that force operates apart from policy instruments of productivity growth. And that force is the job creation as in standard Diamond, Mortis, and Pissarides model, except it operates slower than in that model because this bulge of unemployment created by a crisis creates negative feedback and slow down the recovery. So the conclusion from this research is that it looks like unemployment is little responsive to the disturbances during recoveries, but it still leaves room for policies to prevent or moderate recessions. All right, let me now move on to point 2 about the natural rate of unemployment. So here I have our standard Phillips curve. On the left-hand side, I have inflation pi minus inflation anchor pi star. And on the right-hand side, I have inflationary pressure. So the slope coefficient phi multiplied by the unemployment gap, u minus u star, the natural rate of unemployment. Suppose we have data on inflation pi, on unemployment u, and suppose we also have some construct of pi star, for example, inflation expectations and so on. So under these conditions, phi, the slope of the Phillips curve, and u star, the natural rate of unemployment, are not identified until we bring additional assumptions or some additional data. And so what we did with Bob here, we propose a method that simply relies on the following property of the Phillips curve. If inflation is at its inflation anchor, then unemployment rate reveals U star. So when we look at the episodes when we can use that method, we don't know recessions when inflation equals an inflationary anchor, but the period when we can say that inflation was close to pi star is the recovery from 2009 to 2019. So in these figures, this blue line is inflation, and then this black line with red dots, the black line is the unemployment during 2009-2019 recovery. And those red dots are the months when inflation was within narrow band of the target of 2%. And so basically during those periods of red dots, the actual unemployment reveals natural rate of unemployment. So what we see here that during that long recovery, the natural rate of unemployment closely follows the actual rate. Now, there are different ways that we can identify U star, and so here we summarize these ways in like 3 broad categories. For example, one can conjecture that U star is the long-run trend in the actual unemployment. Or there are other methods where researchers develop a submodel for the unobserved natural rate of unemployment and estimate it together with the Phillips curve. Or a natural rate of unemployment can be a counterfactual unemployment rate in a general equilibrium model when we remove wage rigidities. But what's important that these different methods deliver different correlation of the natural rate with actual rate. So in this figure, I have 3 panels from the different approaches to U star. They're not necessarily representative of the approaches, but they demonstrate different covariance of the natural rate of unemployment with actual. On the very left, we have the figure of the natural rate of unemployment, non-cyclical rate of unemployment from CBO. So blue line is unemployment rate. The orange line is the natural rate from CBO. So there is not much correlation between the two. In the middle, we have natural rate and the actual rate of unemployment from Keene and Morley, and on the right-hand side from Gali et al. Here we see much more correlation between the natural rate and the actual rate. Now, why the correlation between natural and actual rate matters? Because depending on that correlation, we get different values for the slope of the Phillips curve coefficient. And to very quickly see it, so since the natural rate of unemployment is unobserved, suppose for a moment that it is left out from the Phillips curve, and the Phillips curve is estimated, instead of using the unemployment gap, we use the unemployment rate, okay? It's very easy to see that the slope coefficient from this Phillips curve, this phi hat, is actually a product of 2 things, of the true slope phi and this term 1 minus c, where c is an observed regression coefficient of the natural rate of unemployment on actual rate. So if c is 0, that is if natural rate of unemployment is uncorrelated with actual, then phi hat reveals true phi. However, if there is a positive correlation between natural rate and the actual rate of unemployment, then the phi hat from this regression will inevitably be close to 0. So essentially, it's an example of the bias. So the Phillips curve estimated from this regression will be inevitably close to flat if the true natural rate of unemployment is correlated with actual. And so why that matters? Well, it leads us to 2 different views about the slope of the Phillips curve. So we can see those views when we look at the recovery from 2009 to 2019. So one view, which we call sticky and low view, is that the slope of Phillips curve was small, but the unemployment gap was large. So inflationary pressure was low. Another view, the flexible view, is that slope was high, the Phillips curve was steep, but the gap between unemployment rate and natural rate of unemployment was very small. And so both views fit the data, and we need more data to distinguish which of those holds true. But our own evidence and our reading of the recent literature is that it looks like there is substantial correlation of the natural rate of unemployment with actual rate of unemployment. And so under this flexible view, the inflationary pressure during the recovery is low because the gap is low. And under alternative view of sticky view, the inflationary pressure is low because the slope of the Phillips curve is low. And so the summary from this research is that low unemployment does not necessarily signal high inflationary pressure. And so finally, moving to the unemployment and inflation in the pandemic. So very quickly, during the pandemic, unemployment shot up during a very quick period of time of 2 months. And it looks like it wasn't due to a typical deterioration in demand. It coincided with the stay-at-home orders. But also it recovered very quickly. And also it was not due to standard search and matching process that takes time, but rather to recalls. And so when we look at unemployment during the pandemic, in our work, we find that if we want to compare the pandemic recession and recovery to the previous episodes, we should distinguish between the unemployed with jobs and the unemployed without jobs. So who are those unemployed with jobs? Those are the unemployed that are on a temporary layoff and are waiting to return back to work. Who are the unemployed without jobs? Basically, all other unemployed. It's our typical unemployed that we observed in the previous recession episode. So in this figure, we have two lines. The blue line shows unemployment. So basically, it's a temporary layoff unemployment divided by the labor force. The red line shows all other unemployment, jobless unemployment, divided by the labor force. The sum of these two lines gives the official unemployment rate. So as you can see, during the pandemic recession, the entire explosion of unemployment comes from the blue line. The red line, the jobless unemployment rate, didn't reach its peak until November 2020, and the peak was approximately 4.9%, which is half of what it was in the Great Recession, when it was 9%. And so what is the key distinction between these two types of unemployment? Well, the temporary layoff unemployment goes back to normal as soon as economic conditions improve, but there is no search and matching process involved. The jobless unemployment goes back to normal. It takes time for it to go back to normal because there is a long search and matching process to find suitable and stable jobs. And so when we look at the labor market in the pandemic recession, despite unemployment reached this 14.7%, the labor market was tight by many measures. Just now I showed you jobless unemployment rate. Also, we see the tightness by job finding rate. So in this figure, I have two lines. The yellow line at the bottom is a job finding rate of those from jobless unemployment. And the blue line is the job finding rate of those from temporary layoff unemployment. Typically, people on temporary layoff find jobs faster, they just recalled. But if we look at the yellow line, the job finding rate of those from jobless unemployment, right after this gray vertical line, the job finding rate didn't decline that much. It didn't decline that much as compared, for example, to its decline in the Great Recession. So basically, by this measure of labor market tightness, market wasn't that. By this measure of labor market tightness, market wasn't that slack. It was pretty tight. We can also see that from vacancy unemployment ratio. So here I have two measures of vacancy unemployment ratio. The black line is the vacancies divided by total unemployed. The red line is vacancies divided by jobless unemployed. And we argue that the proper measure is actually red line because we should divide vacancies by the searches, which is those jobless unemployed. And as you can see, the red line didn't decline as much as it was in the previous episode. So again, the labor market remained relatively tight. And so to summarize this point, what we see is that during the pandemic recession, the labor market remained relatively tight. The natural rate of unemployment, given our previous research, we think it closely followed the decline of the natural rate of unemployment, closely followed the decline of the actual. And so the question is, what about the inflation? And so we haven't done, in our work, we haven't done that much research on inflation, but what we see is that during 2009, 2019, inflation got anchored at 2%. But then the turbulence of the pandemic brought this extreme volatility to sellers' situation, and the repricing became more frequent. And so what it leads to in the Phillips curve framework, to the steepening of the Phillips curve. But also what it means that when disinflation happens, it can happen at a faster pace. And so to summarize, what we find is that in a cyclical recovery, typically unemployment goes down at a low and predictable rate. Second, in the Great Recovery from 2009 to 2019, natural rate of unemployment likely declined a similar path as the actual rate of unemployment. And finally, during recoveries, the labor market tightness is an indicator of labor market pressure, but not necessarily of inflationary pressure.
Thank you very much. When I was preparing for this presentation, it brought back thoughts of a presentation I gave in 2018 at the 50th anniversary of Milton Friedman's presidential address, in which he introduced the inflation-augmented Phillips curve. And you know, first of all, I was struck by how much things have changed since then in terms of the debate on inflation, where at that time the dominant discussion was about inflation being a few tenths of a percentage point below the Fed's target, and where since then we've all gotten a lot of perspective about that level of misses on the target. And second of all, of course, one is always struck by sort of the remarkable achievement of Friedman's Phillips curve in making this, you know, out of sample prediction that really turned out to be right. And today I've been sort of struck by how often, you know, Friedman's work has come up, and again, we're going to see more of that tonight. So this is the expectation augmented Phillips curve that I talked about then. The first term is the traditional sort of demand imbalances term that we often talk about when we talk about the Phillips curve. But what Friedman added to this discussion, and which was obviously very important in the 1970s, which was his out-of-sample prediction, was the expectation term, which, you know, sometimes we actually forget about when we talk about the Phillips curve, but it's a very important component. And then, of course, there's the supply shock term, which can also be very important, which we've seen rear its head recently. My co-authors and I have found that it's useful for exposition to rewrite this equation in this kind of long-run way. So it's the same equation, but now it's rewritten in terms of a longer-run measure of demand imbalances, which changes the quantitative magnitude of the slope term. So I've written kappa star instead of kappa. But the appeal of writing it this way is that now you have an inflation expectations term that's about the long run. So it can be interpreted more as something like the Fed's inflation target. And this is something, you know, that has been shown to be extremely important in situations like large disinflations, which of course we saw, you know, discussed this morning, you know, in many Latin American countries. It's crucial to think about this long-run inflation expectations term. And then, of course, there's the supply shock term remains. This term, you know, even in the United States, where we haven't had hyperinflations, it used to move around a lot. So this is a picture showing core CPI inflation and the long-run survey professional forecasters measure of expected inflation over the next 10 years. So the black line is actual inflation, and the gray line is this longer-run measure of SPF, inflation expectations. And what's striking about this is a graph that goes back to the late 1970s, is that in the late 1970s and early 1980s, you see that even long-run, 10-year ahead inflation expectations tracked current inflation almost one for one. But in contrast, by 1998, longer-run inflation expectations had almost completely stabilized around 2%. It's really striking that the line becomes essentially flat. This graph, by the way, goes back to before COVID. Okay, so I'm going to talk more about COVID next. But let me first talk a little bit more about where we were before the last 5 years. So we can ask the question, suppose we take into consideration these sort of Friedman forces coming from longer run inflation expectations. How much can the demand imbalance as part of the Phillips curve explain inflation movements? And that's what I'm showing here. The black line is inflation, the actual inflation number, minus that longer term inflation expectations statistic that I showed you on the previous graph. So basically it kind of detrends the series to a first approximation because you had much higher longer run inflation expectations in the 80s and then a downward trend thereafter. And the gray line is showing this demand component of a Phillips curve, so it's just literally unemployment multiplied times a Phillips curve slope that comes from cross-sectional estimation because we have this identification problem that Marianna emphasized. So focusing on the 1980s, 90s, and 2000s, what you see is, a modest relationship between these two curves. So you see that during recessions, like for example, the Great Recession, in the late 2000s, you see that the unemployment rate, of course, spikes up, and you do see a tendency of inflation to tick downward in these periods. And this has been mentioned many times. So there's that tendency. The part that you really can't explain using the behavior of unemployment, interestingly, is the period around 1980, which you really need some kind of supply shocks to explain. So this is again only showing sort of the demand imbalances component of the Phillips curve, and it can, sort of tell you something, this modest relationship where inflation tended to tick down a little bit relative to longer term inflation expectations during recessions. That was sort of what we saw before the recent episode. Okay, so that kind of extended into the early COVID period. So here I'm showing you something even simpler. So as I said earlier, longer run inflation expectations basically completely stabilized around 1998. So we can just ignore them after that period. Subtracting them doesn't really make any difference. So this is just showing the actual unemployment rate. That's the red line. And then the PCE deflator, core. And you can see this, modest relationship I was emphasizing, big recession, the Great Recession, you see inflation sort of ticking downward a little bit. And that was actually true also in the early phases of COVID. You saw a gigantic increase in the unemployment rate, and even more true in some sense, perhaps for the reasons that Marianna was mentioning about the nature of this unemployment, but a very small initial decline in inflation. But then we saw a pretty big divergence. So now I'm adding the next period, the one that's really the COVID recovery period. And now you see, even though it was kind of, in some sense by the traditional statistic of looking at the unemployment rate or the unemployment rate minus a very smooth kind of CBO type of natural rate measure, came down to levels that were low, but not that low in the historical context. They were roughly in the ballpark of where we were pre-COVID, and yet inflation, which is the blue line there, and I'm circling the period I'm talking about, went up a lot more than what we had seen pre-COVID. So that's sort of a lot of the discussion about inflation has focused on that fact, that this modest relationship that existed in the pre-COVID period, we really saw a difference from that in the COVID recovery. Now, one thing I wanted to say as an aside is that there's been quite a bit of discussion recently about the fact that, shelter is a big part of the remaining problem with inflation. And one thing that's striking looking at the historical data is that shelter has always been by far the most cyclical component of inflation. So here I'm showing you the green line is the unemployment rate, The red line is showing you a CPI shelter, and the gray line is showing you non-shelter. And you can see that there's a pretty systematic negative relationship between the unemployment rate and CPI shelter, whereas, who knows what's going on with the rest. And that's sort of continued in the recent period as well. So what was different about the COVID recovery? Because obviously, the relationship changed. There are many explanations. This is a very incomplete list, but, sectoral reallocation, supply chains, fiscal stimulus, unmeasured labor market tightness of various kinds, non-linearities, expectations. There are a lot of expectations right now, and so a lot of explanations that we're thinking about right now. One of the major challenges is identification, because there were so many things happening in the time series that it's hard to tell them apart definitively. Perhaps a simpler question than what caused this divergence, why was there why was there some other force that was important during this period that wasn't before, is just a measurement question. So from a reductive perspective, one might be able to write a lot of these theories as different explanations for why there was some kind of demand imbalance in the economy. And really, the Phillips curve, the demand, this is how I showed it earlier. The traditional term really is just, the unemployment minus the natural rate is some kind of stand-in for a demand imbalance. And so this question of why the demand imbalance occurred is, of course, a very hard question. Perhaps a slightly easier question is, how do you measure that demand imbalance? And here, my comments are very similar to Marianna's. Unemployment minus a very smooth natural rate, like the CBO natural rate, just didn't seem to fully capture what was going on during the COVID recovery. Because according to that measure, we looked like we were in a very similar place in the labor market, in the last couple of years as we were pre-COVID, and yet by a bunch of other measures, such as the vacancy rate and things like this, it really felt like the labor market was quite a bit tighter. But aside from the labor market, let me put that aside. I think that's important. But I think one thing that perhaps isn't emphasized as much, but is also potentially very important, is the extent to which we can see demand imbalances not just in the labor market, but also in the product market. So why would there be these demand imbalances in the product market? Well, an obvious reason was just this massive increase in demand, particularly for goods. So here I'm showing you PCE expenditures for goods, that's the green, and services, that's the red. So first look at the Great Recession. That's the first recession that shows in this picture, and you see sort of the normal thing, that during a recession, both of these fall. And actually, goods fall more than services because, they're more elastic. What was really remarkable about the COVID, recovery, which was so remarkable in so many ways, and the recession, was that while there was kind of a very short-lived decline in goods market, consumption during this period, this very quickly gave way to a dramatic increase, way above the previous trend. And this is just completely different from anything we've seen in the historical record. And so naturally, this was something that led to some pretty major imbalances in the goods market. So one way to see this, which again, it isn't the traditional term that we use to represent demand imbalances in the Phillips curve, which is U minus U star, but I think it's really getting at the same type of issue, is delivery lags. So here I'm showing you a graph of 3 different measures of delivery lags. This is something that we don't have, I think, long enough term measures of, and maybe systematic enough measures of, and maybe something that would, deserves further emphasis and has gotten a lot more emphasis recently. But if you look at the blue line, which is the Global Supply Chain Pressure Index, or the black line, which is the Purchasing Managers Index, you see that the delivery lags, the amount of time it took for you to get something when you ordered it, were larger during the COVID recovery than in any time, by far, than in any time in the history of those indexes. Even if you look at the ISM index, which goes back a lot further, you see that the delivery lags during COVID were higher than they had been since the 1970s. I remember seeing Greg Mankiw at a meeting of a CBO meeting during this period, and we went and there was no flat panel TV screen on the wall. This was used for the presentations. And then they explained the reason was because, of course, they had ordered it, but it hadn't arrived. And Greg said, well, we haven't seen shortages like this in the U.S. economy since World War II. And I think we all had experiences like this where, we were sort of used to just buying things, and it just didn't happen during this period. So here I'm again kind of reminded of some older work by Dennis Carlton, where he emphasized the importance of delivery lags in equilibrating industrial markets. So he studied this great data set of Stigler and Kindall, which showed that there was this remarkable extent of price rigidity in individual transactions on industrial goods, which was very surprising because a lot of these industrial goods, we might think of as fairly homogeneous. And he argued that in the context of this price rigidity in contracts, actually delivery lags could be a very important, part of how the market was cleared. And this is something I think we saw, really come back during the COVID period. So the last thing I want to talk about briefly, because I spoke so much about inflation expectations at the beginning, is forecasts. So a pattern from the past is that historically forecasters have tended to underestimate the persistence of changes in macro variables. So some examples of that. So here's a plot that some people call the hair plot. The black line is T-bill rates, and the dashed lines are showing forecasts of these interest rates going out for the next year. And this is going back to the late 1970s. And so over this period, of course, you're seeing interest rates fall. But what's really striking is all the times, and perhaps some of you can think back in your memory and think about what were you thinking at these moments in time, where people just dramatically underestimated the persistence of a change that was going on. So an example of this, for example, that we can probably, most of us can remember, is the Great Recession, where repeatedly people really thought, they just had no idea how long these zero interest rates were going to last. Everyone thought, no, it's going back to normal, it's going back to normal, it's going back to normal. But no, it didn't, for years and years and years and years. And it wasn't the first time that happened. You can also see it earlier on, in the 2000s. There were many times when we've seen this. And it's not just about interest rate forecasts. You can also see it in GDP growth forecasts. So this is also kind of fun to think back on. Again, in the Great Recession, you saw people were very convinced, forecasters, this is the CBO, but this is true of private sector forecasters as well. There were repeated periods, in the recovery after the Great Recession, where there was the belief that, the growth was going to go, was going to rise back to previous levels. In addition, kind of an entertaining example to think back on is the late 1990s, when growth was at really high levels, but repeatedly forecasters thought that growth was going to fall back to earth. And they thought this over and over and over again, until finally they updated to believing it was going to be more persistent right around 2000, when, unfortunately, it was just about to unwind. So, the conclusion from this that I want to draw is just that, it's definitely not an iron law, but there is a bit of a tendency in recent economic history to underestimate the persistence of these kinds of movements. And one thing that I've been working on, and I think one could have a sense of if you've been thinking about these things over your career, is that this doesn't have to be all irrationality. Some of it is just a short sample. We haven't seen that many cases. We certainly haven't seen that many cases like COVID. And when we have this short sample and we're trying to do our best, it's hard to be rational. Even if we are trying to look at all the data. But there is this tendency in the recent past to see that people underestimate the persistence of events. And of course, that's been something that I think is sort of well worth thinking about in the context of inflation today. So let me stop there.
Okay, so we will take questions from the floor. And remember, please state your name and affiliation. So we'll start with John Cochran, and then I can't see your name tag, you'll be second. And then Jim Bullard.
I have a talent for raising my hand fast because I know lots of people will want to get in on this one. Just a quick one for Marianna, if you can. The lesson I get from your plot, and I want to know if this is right or not, is that starting about 2010, U equals U star, we're in real business cycle land. And all this business about forward guidance and quantitative easing and negative interest rates and fiscal stimulus is just a waste of time. You got to sit there, supply equals demand, call us in the next recession.
That's exactly right.
Bingo, I don't have to say any more. Thank you. Krishna Guha with Evercore Partners. A question also for Marianna, but anyone else on the panel who'd like to address it as well. There's an interesting story whereby the very elevated level of churn in the US labor market around the pandemic, as seen, say, in the JOLTS flow data, quits and hires, is associated with breaking stale matches and allowing new, better quality matches to form under a strong labor market subsequent as the recovery got underway. And a contrast sometimes drawn between that and the European situation, where furlough-type programs locked in place old and stale matches. It could have different implications for productivity going forward. I was interested whether, for instance, Marianna, your distinction between temporary layoffs and jobless would lead you to reject that as an important story as to what might be going on, or alternatively, whether you'd still see a place for that within the sort of larger framing that you provided. Thank you.
Thank you, Jim Bullard, Daniel School of Business, Purdue. I have two questions for Steve Davis. So one question is, you know, you tell a story about remote work technology. The technology was around pre-pandemic, but why weren't the firms using, if it was so beneficial, why weren't firms using it more pre-pandemic? Why was it that this was all revealed by the pandemic shock? So do you have a model of they had to learn about the technology or something like that in mind, and there would be some transition in there? And then a related question would be, you know, these workers that are living more than 50 miles from their employer, that sounds like a contract worker to me, or an outsourced worker. So why isn't the firm just saying, okay, I'll just hire you to do some stuff for me, but you'll be a contract worker since you're not going to be at the firm, and you'll do the work that way? And how would that change some of the data that you're showing about sort of the nature of work? Not only can it be outsourced 50 miles away, but 5,000 miles away. So that's another consideration.
Okay, I'm going to let the authors answer the first three questioners, and then the first one after that, next questioner will be Pat Kehoe.
Okay, so on the first question about whether during the recovery the economy resembles more real business cycle economy. Yeah, this when the slope is large, essentially we can rewrite the Phillips curve in a supply form where we have U equals U star, and there will be term 1 over phi multiplied pi minus pi star. And so the larger the phi, the smaller the effect of this pi minus pi star term. So the higher the phi, the more closer to the real business cycle economy we are. So, yeah, then there was a question about stale matches.
Yeah, good.
So I didn't exactly understand about the stale matches, but in the US, there was lots of temporary layoffs. As I understand, in Europe, there was lots of government-sponsored furlough programs, right? And so when we look, I actually have a paper when we do a survey what methods firms use to adjust to the shock. Some used permanent layoffs, some used furloughs, but not much temporary layoffs were used, because essentially those were government-sponsored furloughs. You were asking whether that allowed to keep stale matches, and we should probably look at the productivity and to understand whether what happened with the productivity.
Yeah, thanks for the questions. On why weren't we doing more work from home before the pandemic? Yeah, the basic explanation turns on the costs and the consequences of experimentation. There was a rational reluctance to experiment, I think well captured by a quotation from Morgan Stanley CEO James Gorman in 2020. Speaking about his own organization, said, "We never would have tried to work remotely of our own accord, of our own free will, because the risks of getting it wrong were too high." So that's the rational reluctance to experiment. The other thing that was interesting about the pandemic is there were certain kinds of experimentation that were impossible to do before the pandemic. And so you couldn't learn about them even if you wanted to. So think about a professional services firm. You could have said, well, we're going to see what happens when all of our employees work remotely. We're going to try that for 3 months. And just to make sure we see how this experiment works, we're going to make all our customers and suppliers work remotely at the same time. That's the experiment that we ran. Okay, but obviously that's not an experiment that would have been feasible for any single firm to run in advance. So my interpretation is that there was a mass compulsory experimentation. There's lots of new information revealed by that. I have direct evidence on that of the following sort. We first did first did this in the United States. We asked workers, well, how did it work out for you? Did it work out poorly, well, and so on? And there were a range of responses, of course. But it turned out there was a very strong positive relationship. Those workers who claimed that they were more successful than they had anticipated in terms of productivity when working remotely were the same ones whose employers planned for them to do more work from home after the pandemic. So survey-based measures of who was favorably surprised by their work from home experience line up very well with then employer plans for what they would do after the pandemic. We were so struck by that result that we, about a year or so later, ran a global survey across 27 countries, same kinds of questions. We found this kind of relationship in every single country. That is, there were many individuals who were favorably surprised by how effectively they could work from home relative to their expectations. And it's those same employees in each country who had employers who said, you know what, you're going to work from home some of the time going forward. So I think costs and consequences of experimentation, I've tried to explain why the experimentation didn't happen. It is important to understand that the same pandemic event, had it happened 20 years earlier, would probably not have resulted in the same response and working arrangements because the preconditions, the internet and broadband internet access in the residential sector, the cloud, collaboration tools, video conferencing technology of acceptable quality, all of those things had come online more or less in the previous 20 years. And they were essential to make this technology work well. So that's what I think happened. You can write down a model that tells you that, but I think the evidence is more compelling. On your second question about the people working, living more than 50 miles away, not in that particular study, which is based on payroll data, but back to the survey, which I mentioned for a different purpose in the survey Business Uncertainty that runs out of Atlanta Fed. The executives who tell us that they are relying more on remote work in their organizations as a way to moderate wage costs also tend to be the same ones who are turning more to contract workers. Okay, it's not a huge effect, but it's direct. It's in the direction. So there is some of what you say, but I think it's also important to understand that the biggest shift in working arrangements isn't from traditional working arrangements to people working remotely 5 days a week or so. The biggest shift is people who used to work on site 5 days a week who are now working at home a couple days a week or 3 days a week. And for those people, apparently their employers and employees themselves feel that some face-to-face contact each week still is quite important. So I don't think there's as much scope for outsourcing abroad for those people as there is for the people who are working in an almost entirely remote capacity, where I kind of share your view that that does seem like it's ripe for outsourcing abroad or even just outsourcing somewhere in the United States.
Pat Kehoe?
I think this is for Steve, and I think you answered some of this. Is there much direct evidence on productivity at home versus productivity in workplace? I mean, from an anecdotal sense, I have some administrators, assistants, whatever. You try to call them on Thursday or Friday, they're at home. There's Zippo response. And then during the week when they're here, they're right there. But I mean, doing that systematically, you know, I thought my productivity would go to 0 when I was at home, so I was favorably surprised, but it was still lower than when I was at the office. So just speak to direct, is it possible to get direct evidence on that or not?
Yeah, it is possible, but, so look, first you hinted at something that's important at the end. If you write down a little model of how surprises about work from home, productivity in the work from home mode affect outcomes after the pandemic's over, if you start from a low enough base, you're right, even a positive surprise, you're still gonna go back to the pre-pandemic arrangements. So that point's right. Look, we have a range of evidence now. It's complex and difficult to interpret for the following reason. But I will give you my overall interpretation. But first, let me tell you what the inference challenge is. What you would think of as hard evidence of the sort that economists like from their quasi-natural experiments. Those studies were done in 2020. But they don't really answer the right question. The question these studies during the pandemic answer is, what happens if, with no advance warning, in an organization that's unprepared and workers who are unprepared, everybody suddenly has to work from home without knowing what the hell they're doing, without knowing how to use the technology, without having the complementary investments. A lot of those studies that were done then find out, you know what, there's a big productivity loss. But that's not the relevant question. The relevant question is, going forward, when you select on who works from home, in what activities, when the organization has a time to figure out how to make it work and so on, when you kind of select and optimize on the work from home mode, then you tend to see more favorable developments. Now that unfolds over time, so it doesn't lend itself quite as naturally to a natural experiment. But I think perhaps the best overarching evidence that it seems to work okay in many jobs and activities is the picture I showed you, which is about 4 times the level it was before the pandemic. And while the US is a bit of an outlier on the extent of the increase in the work from home rate, this phenomenon is global when you focus on people who are college educated. So I think that's, to me, that's the most compelling evidence that there were a number of people who were surprised. The other thing that's worth remembering in this context is before, almost everybody was at a corner, the corner being traditional working arrangements where you're on site all the time. And even if only 20% of the folks who are forced to experiment learn that, well, you know, we don't have to be at a corner. We can be at an interior where we're working 2 days a week at home, and I can, as long as I allocate my tasks effectively over the week, you manage your RAs effectively, and so on, we can get just as much productivity as we had before, but we save on the commute, we get the other benefits. That's my interpretation of what's happened.
Before we go to Bob King, who's the next questioner, he'll also be the last. I'm going to use my chair's prerogative just to interject a comment. The Economist yesterday had an interesting article, and it turns out one of the numbers was from Steve's survey. And you know, everybody knows that Europeans work about 15% more hours, or sorry, Americans work 15% more hours than Europeans. And you know, Ed Prescott wrote about this, saying it was the taxes. But it turns out, based on the evidence from Steve's survey, is that Americans are much more likely now to work from home. So they actually spend fewer hours in the office than Europeans, even though they work more hours overall. I just think that's fascinating because I think about these long run trends. So go ahead, Bob King.
So I've been fascinated by the Hall-Kudlyiak research program. I have one question and one quotation. So the question is, can you elaborate on what the core structural features are that lead unemployment to behave so differently, the natural rate of unemployment to behave so differently than what we might expect out of this standard DMP model, where the transition dynamics force things back really fast. So I'm curious about how you're going to spell out the real business cycle dimensions. And the reason partly I asked that question, Marianna, is in connection with your comment about what happens if you take a steep Phillips curve and then you divide by, you change the variables on the different side of the equations, and you get a flat relationship in another dimension. And what I remember from long ago when Tom Sargent was running regressions like that, I think it was Tobin, or maybe it was Modigliani, who suggested that they were treating unemployment as an attack of contagious laziness. And so it's clear that in your vision of the world, the natural rate of unemployment is moving around a lot. So it would be great to know why.
Okay, so the most important thing to say is there's a 50-page paper in the Macro Annual in 2021 that's aimed exactly at Bob's question. It's more successful in disposing of kind of standard ideas than it is in erecting a completely plausible new idea. But what's required in that analysis is something that really slows down the recovery process in the labor market relative to what the DMP model says. So we construct something which involves all the same assumptions of DMP, except for a congestion effect. And there's a small literature on congestion effects in the DMP model, which we support. But this is still a research program. But we can eliminate things that are just sort of obvious, like it takes a long time for people who've lost work in a major cutback compared to, and there is a literature on that. Steve Davis, in particular, is quotable on that. But we show that it's not nearly big enough to account for the actual slow but steady and predictable recovery. But it's very much a fact. That's what we'd emphasize at this stage, is that it's very much a fact. And it really does not make sense. The current state of that is that we're very confident that you should not draw a horizontal line to represent the natural rate of unemployment. And we've done a very thorough scrubbing of the literature on that, and which is all this material is available on Marianna's website.
So let me also add, so basically the thinking is that if the actual unemployment is 9%, it takes time for these unemployed to find jobs, to go through search and matching process. So if actual unemployment is 9%, then natural unemployment should be somewhere close to that, because search and matching process takes time.
All right. Thank you, everybody. Thanks for the great papers. Thanks for the great questions.